All right, welcome. So today, we're going to tackle a topic that, let's be honest, can sound pretty complicated, maybe even a little scary: futures and options. But don't worry, I promise we're going to break it all down and make it super simple to understand.
Yeah, if you've ever heard terms like futures trading and kind of felt your brain just shut down, you are definitely not alone. But hey, stick with me for just a few minutes. By the end of this short explainer, you'll see the core idea is actually really straightforward.
Okay, let's dive right in. Before we can even talk about a futures contract, we've got to start with the big picture, the category they belong to, and that is derivatives. This is the foundation for, well, everything else.
Okay, so take a look at this. On one side, you have a plain piece of paper, worth pretty much nothing. On the other, a 100-rupee note. Now, why is that? They're both just paper, right? The difference is the promise, that signature from the RBI governor. Its value isn't in the paper itself. It comes from somewhere else entirely.
And that right there, that's the whole idea behind a derivative. It's an instrument that, on its own, doesn't really have any intrinsic value. Its value is derived from something else, what we call an underlying asset, just like that banknote's value is derived from a promise.
Here's another really easy way to think about it. Imagine a key to an empty locker. It's just a chunk of metal, right? Pretty much worthless. But what if that same key opens a locker with $1 million inside? Whoa! Suddenly, that key is incredibly valuable. The key is the derivative. What's inside the locker is the underlying asset.
Okay, so now that we get the basic idea, let's see how it plays out in the real world with our first type of derivative. And it all begins with a simple story about a farmer.
So picture this. You've got a farmer who's growing potatoes. He's worried that in 2 months, when his crop is ready to sell, the price of potatoes is going to crash. On the flip side, you have a big chip company that needs those potatoes, and they're worried the price is going to shoot through the roof. So what do? They get together today and agree on a price for a sale that's going to happen 2 months from now. See what just happened? Both of them got some peace of mind. They locked in a price and got rid of all that uncertainty. And that agreement, that simple, private deal for a future transaction, has a name. It's called a forward contract. But, there's a catch. A pretty big one, actually. Since this is just a private handshake deal between the two of them, what happens if, 2 months later, the farmer delivers the potatoes and the chip company just backs out? The farmer is left high and dry. That's a huge risk, and it's called counterparty risk. So, how do you fix that? How do you get rid of that risk? Well, this is where the whole idea evolves into something way more powerful and, most importantly, secure. And that brings us to futures. So a futures is basically a forward contract on steroids. It's the same idea, but with one absolutely game-changing difference. Instead of the farmer and the company dealing directly with each other, they both deal with a middleman they can trust, the exchange. The exchange steps in and guarantees the whole thing, which completely wipes out that counterparty risk we were just talking about. All right, so that's the theory behind it, but how does this all work when you're actually trading in the market? Let's use a really simple analogy to make this super clear. Let's stop thinking about futures as some complicated legal contract for a second. Instead, just imagine it's a magic token. And if you hold this token, it gives you a claim to an asset, like a share of a company, at some point in the future. And this is where it all clicks together. If the token represents a plot of land worth $1,00,000, then guess what? The token itself is worth around $1,00,000. Simple, right? It's the exact same for stocks. If you have a token for an MRF share, which is the future contract, its value is tied directly to the price of that MRF share. Okay, so why would you even bother buying one of these tokens? Well, it's pretty straightforward. If you think the actual price of that MRF share is going to go up, you'd buy the token today. And if you're right and the share price climbs, the value of your token climbs right along with it. Boom, you've made a profit. Of course, if the share price drops, your token loses value too. Now, this is probably the most important part to understand about how people actually use these. Almost nobody who trades futures is actually planning on getting a delivery of those shares. That's not the point for them. What they're really doing is just trading the token, the contract itself. They buy it, hope its value goes up, and then sell the token to someone else to lock in their profit, usually way before the contract ever expires.
Whew, okay. That was a lot, but hopefully it's all starting to make sense. Let's do a super quick recap of the most important things you need to remember.
First off, a derivative. Its value is derived from something else. It has no value on its own. Next, a forward contract. That's just a private agreement between two people. Then you have a future. It's basically a standardized forward contract, but with the stock exchange in the middle guaranteeing the whole deal. And finally, when it comes to trading, just think of it as buying and selling these tokens whose value goes up and down with the price of a real asset.
So, there you have it. You now know what a future is. The mechanics aren't so scary after all, are they? But this leads to the real million-dollar question, doesn't it? If you believe a stock is going to go up, why would anyone buy the token instead of just buying the share itself? Answering that question, well, that's when you really start to understand the incredible power and the real risks of the futures market.